Hey guys, Steve Brand here, your favorite mortgageguy.com. I wanted to get in touch with everyone and reach out to you as we approach the end of this year and go through some educational information on the federal funds meetings and what the Fed funds rate is, and what the possibility of things are going to be happening as we approach the end of this year. I thought it was really important. It's so important. Let's take a quick look at what the definition is and the history for the last, 10 years. The actual Fed funds rate is the interest rate that banks lend to each other. It's what depository institutions lend balances to other depository institutions, other banks, on an overnight basis. That's what it is. And if you look, since 2009, you'll actually see that banks have been lending money at zero. The Fed funds rate was higher than that before. And the Fed funds rate is not prime. Prime is what's used to as a basis for credit cards, also for your home equity lines of credit and things like that. So what does that mean to you? What does it mean if the Feds do raise rates this upcoming December? Let's take a look at, well, I like to use in the financial world that if the past can predict the future, what would happen? Let's take a look at, let's go all the way back to 2004. Take a look at this chart and you'll see that in June of 2004, the Fed funds rate was at 1. So it's higher than it is right now. And the 10-year treasuries were at 4.73. Treasuries have a more of a direct relationship and a correlation to mortgage interest rates. I'll show you that in just a second. So in 6 months, they raised the rates 4 times from 1 up to 2. And you'll see that the treasuries, the 10-year treasuries, moved down almost half a point. Then in the next 6 months, the Fed funds rate made a few more hikes all the way up to 3%. So in 1 year time span, Fed funds rate went from 1 to 3, yet 10-year treasury yields went down from 4.73. They went down almost 3/4 of a point. Now, after that is when things kind of went up. So if you look at the immediate response of what happened in the first few months, and this is just in the first couple months, the knee-jerk reaction is that treasuries go down, mortgage rates go down. Let's take a look at the more immediate, more recent Fed hike, which again was on December 16th last year. So just about a year from now, you can see by the little black circle. And what happened after that is the 10-year yields went down quite a bit. What does that mean when it comes to mortgage rates? Take a look at this chart, circled in the red. January 16th, interest rates were, probably 4.125 or so. And they went down in the next couple months to about 3.5-ish, 3.625. So somewhere in that zone. So they dropped a nice chunk as a knee-jerk reaction to when the Feds did their thing to actually raise interest rates. So the reason for this video is I want to get in touch with some of my clients who have closed loans for, and your friends and neighbors, of course, forward this. Let's take a look at what your situation is right now. And if nothing makes sense to do right now, let's take a look. Is it another quarter? Is it 0.75%? And then it would make sense to do a refinance, whether it's sticking with a 30 and a 30 or makes sense to go into a shorter term when the rates do make that adjustment. So that's really what I wanted to talk to you about, is to have that conversation now and be preemptive for in a January, February timeframe. It's just a quick phone call. Hey, Steve, did we hit 3.25? Did we hit 3.5? Whatever it needs. Yes, we can lock in your interest rate, collect docs, pull credit, order appraisal, and knock out something for you. That's kind of my whole idea behind sending this out, is giving you an idea behind the background of what the Fed funds rate is and looking at past performance to see if that's going to be something that can really be crazy this upcoming new year. If you have any questions, please get a hold of me. My information's below. Talk to you soon.